Thank you for joining iMeet. When you hear the tone, you will be the 22nd person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. Can everybody hear me okay? Sounds like it, okay. All right, listen, today we're going to just go over some of the different sectors, look at the indexes. We have a little bit of fun and talk a little bit about an investment strategy that's been around for about 30 years called investing in the dogs of the Dow. If you haven't heard of that, especially if you're a little bit older, it may be an investment strategy with a good proven track record that might make you some money. Okay, after 3 straight weeks of higher market prices, last week we saw the Dow Jones, the S&P 500, NASDAQ, and the Russell all hit new all-time highs. And we also had the Dow Jones Transportation Index hit a new 52-week. If you weren't long going into the election, probably a little bit hesitant to chase into the rally at this stage. I do think it probably goes a little bit higher, but our CTI is projected to go to a bearish market posture in about 2 weeks. So I think if I would be looking at maybe some runs on stocks that I may want to take a profit in. The different indexes are overbought by just about any measure that we can look at. And I'd expect this week to be a little choppy. We had a down day yesterday. We were off a little bit this morning, mainly due to Iran and Iraq not coming to terms with the new OPEC agreement. We'll go into that a little bit later on some of these oil stocks. But I'm not seeing really any negative divergence, which is good, except for the being overbought. So I think you have a little choppy week here. Any little dips would probably be bought. Funny with the Russell 2000. Yesterday we ended a 15 straight day rally. The 14-day RSI actually was 100 for the Russell 2000. You don't see that very often. But overall, in the broader market rally, we're seeing the right groups lead. Small caps have had a great run. Of course, that they benefit from lower tax rates, and also we see the transports outperforming, which speaks well for the economy going forward. If you're making goods, you want to see someone has to move them, so that would be good. Now, one thing is a red flag. Last week we saw the percentage of bullish advisors, which is a contrarian indicator, hit 55.9%. The last time it was close to that was back on September 2nd. I think that's when we went to a sell in the market. In fact, the Dow fell about 2% over the next couple weeks. We also saw the AAII survey come in at 49.9%. That's the American Association of Individual Investors. That last time it was close to that was back in February of 2015. We had about 47% of the individual investors were bullish on the market. And of course, the market went down 4 of the next 5 weeks. So a little bit of exuberance going on at this stage, which also signals to me in an overbought market that you probably have some choppy action going forward. All right, so anyway, let's take a look now at the dogs of the Dow. Okay, again, if you're not familiar with this investment strategy, what you do is you go into Dow Jones. You're going to select the 10 stocks that have the highest dividend. Okay, and the twist on this is actually the small dogs of the Dow, which only includes the bottom 5 stocks. But anyway, this has outperformed the Dow by about 1% over the last, say, 20 years. However, if you add in the dividends, and normally you're going to average out at about over 3% on dividends, it's done quite well. You actually outperformed about 3%, 3.5%. The dogs of the Dow, the small dogs of the Dow, has done a little bit better. It's over the last 20 years has returned about 12.6%. But I think that's a little bit more risky mainly because with holding only 5 stocks, if one of them runs into trouble, you're going to have a bad year. But anyway, the thesis of this is that the companies in the Dow don't usually cut their dividends. In fact, they generally will tend to raise their dividends. So the stocks that their stock prices have been depressed will have the highest yields or the highest dividends. And what that probably points to is that these stocks may be at the bottom period of their business cycle. And in theory, they should see their stock prices increase faster than stocks with the lower yields. Okay, that translates, again, to oversold stock prices and strong dividends. So if you're a conservative investor, this probably is right up your alley. Okay, now from 1992 to 2011, the Dow returned about 10.8%. That saw several boom and bust periods, including the dot-com period and all that. And over the same period, the S&P 500 has returned 9.6%. Okay, this list that you see in front of you, this is the stocks that you'd be holding this year if you were in this theory, or in this strategy. Okay, you have Verizon, Chevron, Caterpillar, IBM, ExxonMobil, Pfizer, Merck, Procter & Gamble, Walmart, and Cisco Systems. And here's your yield over here. You're getting anywhere from 3.5 at this stage now down to 2.8 on Walmart, down to 4.5 on Verizon. And over here, you see the year-to-date change. This is as of last Friday. You've had some pretty nice returns on these things because usually these are beat-up stocks. Here's Chevron, 23.4. Caterpillar, 1% you've made on that stock this year. A couple other was 18, 16, and 10. So basically, it's been a pretty good year. Year-to-date on this, you are currently up 15.2% versus the Dow Jones being up 9.1%. Yeah, okay, here we go. As of last Friday, you bought the dogs of the Dow, you're up 15.2%. You're getting about a 3.5% yield, so maybe closer to 18% on that, versus the Dow Jones being up about 9.1%. Not bad. Here's the small dogs of the Dow, 10.5%. You're still beating slightly, but again, I think there's a little bit more risk with only the 5 stocks versus the 10 stocks. But you're having a good year with the dogs of the Dow. And also, you have to remember too, though, that this year we saw the high dividend stocks really outperform the broader market due to the interest rates being down around 0. If we go back here, this would be 2015 to see how we. You owned AT&T, Verizon, Chevron again, McDonald's, Pfizer again, General Electric, Merck, Caterpillar, Exxon and Mobil, and Coca-Cola. Now, you didn't quite do as well here. You're basically flat. You lost 1.2% versus the Dow being up 0.9, but you also picked up almost 4% in dividends. So you had a profitable year if you did this. You had a couple, pretty bad shots in here with the Caterpillar. They were still on their way down, but the Caterpillar this year was up 41%. Okay, the next one is what we'd have if we did it in 2014, and that one you were up 7% versus the Dow being up 9.1%. You were making about 3.5%. Small dogs of the Dow beat it that year. They were up 10% and had about a 3.5% dividend on that. Again, a lot of the same stocks have been beaten up here, so you're not getting the high growth ones. But what one of the reasons this thing works is again, because these stocks have been beaten up so bad, but they do pay good dividends, so that puts a bottom under them, and it gives them a chance to ride the thing up a little bit higher. Now, if you're going, usually they start this thing at the first of the year. So, if you're going to start a portfolio today, these stocks here would be the ones that would be included. And again, I would generally they start this on January 1st, January 2nd. That's just as for a benchmark, makes it easier to track how you're doing. I've seen some advisors or some websites that you update this every quarter and you put in some new, again, you go back to the highest yielding stocks. I don't recommend that. The reason being is because you're cutting off the upside on some of these stocks. Like you saw this year, Caterpillar's up 41%, but if you would recalculate it every quarter, you would have probably sold Caterpillar back in May, so you missed a lot of that upside. So it doesn't make sense to me You're buying these stocks because you think that the stock prices are depressed and they have a good ways to go. So to me, I would, just doing it first of the year, following year, just go ahead and roll that money over into the new 10 stocks and, just rebalance your portfolio. Let's see here. Okay. One last thing I want to put in here, and that is that if you come in here, if you're looking for a time-tested strategy anyway, this would be just something to offset. You're buying a index fund or something like that, and you could also do the same thing if you wanted to make it a little bit easier. You can find some dogs of the Dow. There's a dogs of the Dow ETF, which I don't have, but then again, you're going to pay some management fees on that. So again, when it comes around to January, you can find these stocks. Just do a search on Google and say, give me the top 10 yielding stocks, and it'll allow you to build that portfolio starting the first of the year. And again, it's got a nice track record. I think it might be something that, especially for older investors, looking for a good, monthly dividends and all, would be a good strategy for you. Okay, next I want to take a look real quick at some of the major averages and just see if we can get some targets working out on some of these. The Dow Jones, you can see down here, here's the 30-day stochastic, way overbought. It's up here around 98 or something like that. 14-day RSI was up in the 90s. But the MACD long-term, you still got a strong bullish trend. However, it's getting overbought also. Now, one thing that's noticeable in here, and these moving averages, I included the 21-day, because you're so far away from the 50 and 100, 200-day. But you have a little bit of a flag pattern here. A lot of technicians will take this from this point to here. You can measure that with your fingers, and then going up would give you a target on the Dow of about 19.4. I have a target on the Dow probably closer to 19.3. I think that's where we probably struggle to go any higher at that stage, especially if we get a little bit of pullback, then we can make another run to that. S&P 500, again, way overbought. And I want to show you something on this when we talk about targets that we've talked about before in the past, how you can come up with targets. If you look at some of these moving averages, say off of the 100-day moving average, let's go back here. You take your fingers for that moving average and click up there. You're going to get, take your thumb on the moving average, your forefinger on the above that. Then go over to some of these other places where you see the rally. Okay, this area right here, where if you measure that with your fingers and go back to over here, you got about the same distance away from that moving average in both places before you had a pullback. So you reversed here and you ran back up here. That's about the same distance again as is here. Again, you sold off. You come back over here. You didn't quite make it up that high back here in the summer, and you haven't quite made it up to that high here. But if you do measure that, that would give you probably about a 2250 on the S&P 500, which is in line with where I think we can probably get this rally. And if you look down here again, we're way overbought on the indicators, but we have a nice, we're not overbought on the MACD yet, and that's showing that the trend should be up from here, and that should give us a little bit more ways to go. Okay, here's the NASDAQ. You can see a nice ascending trend line here. Came down, bounced off that trend line back in before the election, I guess that is. And here's where we broke out of the resistance. Again, this has underperformed a little bit. The reason being is if the FANG stocks that everyone talks about have underperformed. They had a pretty good sell-off back in here, and then also they didn't participate much on this upside right here. The reason for that is these stocks get a lot of their revenues overseas, and the stronger dollar, especially in multinational industrials and also the technology stocks, is going to hurt the profits on these things as they bring the money back to the States. You're going to have a currency exchange problem that's going to clip their earnings for a little bit, and that's why they've underperformed. Now, if you look over here at the Russell, okay, here's that 15-day rally, 15 days straight. The reason, part of this, the reason these small caps have outperformed, I touched on it earlier, is because the tax rate goes down for these smaller companies. That benefits these companies, and the tax cut goes right to their bottom line. And they don't have a lot of fancy lawyers or accountants that are help them cook the books to make to find tax write-offs. So any kind of a tax break for these companies is very bullish for them, and I think they should probably outperform going forward. But very overbought. Here's that 14-day RSI where we actually hit 100 a couple of days ago, and that's about as overbought as you can get. So I would expect to see some kind of pullback in this area. Okay, here's the Dow Jones Transports, which we mentioned back here, mentioned here. Every time we got to try to break out, it couldn't push through. Well, we finally got that big breakout over here, and I wanted to also draw this in here, this line here. This is a great reverse head and shoulders, which is a bottoming pattern. It's recognized by most technicians. And if you want to come up with a target here, I don't go all the way down to here, but if you come in here where we had a few downward points, right around 6,600, I think it is. Then you go up to here where the neckline was on this stock, which is coming in. If you measure this and then add it on to where we broke out from here, it's going to give you a upside target close to 9,600, maybe 95, 9,600. So I think the transports have a good ways to go. That also speaks well for the broader economy. If we're making businesses are making a lot of goods to sell, someone has to move them, and then it's not always Amazon. So if you own any of the airlines or railroad or trucking stocks over here, you're quite pleased with this rally because they've really outperformed. I think the transports were up something like 11% or 12%. The S&P was up. I mean the Russell was up about almost 13 to 15% over this time period. Okay, next I want to touch base on what's leading this rally. This is over the last 1 month. Okay, of course, with the stronger dollar and the talk of the rates going up, the beneficiaries of that is mainly financials, which includes insurance stocks, regional banks. Regional banks will make this as long as the rates go up. That helps them charge more. They make more, and they can make more on the spread between loans. So the financials have led this thing up 12.5% over the last 30 days. Industrials, again, the economy's getting strong. Stronger dollar means the economy's stronger. They're up 9.3%. Be buying the multinationals quite as heavy as I would. I'd look for companies back that mainly probably get at least 75% or 80% of their revenues here in the States. Consumer discretionary stocks have done quite well in here, up 5.8%. That doesn't include, for some reason, it's not including the Home Depot. It's underperformed, and Lowe's, which I'm not sure why. But anyway, some of the specialty retail stocks, the Ulta salons and some of these. I know Costco is doing well. Dollar Tree, some of those stocks have done quite well. With the Christmas season seems to be off pretty good, so I would expect to see this sector also to continue to go higher. You have the material sector, XLB up 5.4%. That's mainly due to the that's up despite the oil kind of going sideways. But this is built mainly due to the talk about infrastructure spending. And lastly, you have the healthcare up 2.38%. I thought that would probably go a little bit higher. It's beat up as the biotechs and all were. I would expect that to increase. Now the biotech sector has gone, not sector, but industry has gone up, has outperformed this. What's holding this back is still some of the big name pharmaceuticals like the Mercks and the Pfizer. So that's kind of it right now for the sectors. I did want to get to some of the. I had a lot of questions came in asking to look at a couple stocks because we were off last week. First one I want to take a look at is VXX, and this is basically an ETF to trade the VIX for the S&P 500. And you can see it's just keeps going lower and lower. And I'm assuming that the guy who asked about this was wanting to play this for a bounce, which, eventually always happens. But you don't want to buy this thing and just wait till and figure one day you're going to have a correction in the market, because if it doesn't come within a week or so, these things tend to just to always go down with the market due to a time element that they can come in here. So I'd be more inclined to maybe look at this for a bounce when we go to a bearish market posture with the CTI, maybe in about 2 weeks or so. Because otherwise, you're sitting here going, well, I don't want to miss a quick correction in this thing. You might be down 25-30% before you even get that correction. So again, wait for this thing until you start seeing some negative divergence in the different indicators. Maybe you start seeing a sell-off in the AD line, or a cut up in the 52-week new highs and new lows. No matter how oversold this thing is, some things can stay overbought or oversold when they're trending. Wow. Okay, next we had somebody wanted to know about the consumer staples. Okay, this is actually the worst performing sector over the last 30 days. You're down 2.5%. I think you had a little bit of a bounce here over here, but that's a pretty steep decline in that. We are oversold. It's down in here. It was due for a bounce. You have a trend line down here around 50 that could give it extra support. The reason this thing is selling off, investors kind of look at this thing almost as a kind of a bond proxy. They want, they're looking for some growth, but they also want low risk, and they want to get paid while they own these stocks. Okay, there will be a bottom in this group, but over the last, there's probably over here somewhere. We've been talking all through the summer. I guess that was over here, where I was saying I don't like this group. Mainly because back in here that was trading at 23 to 25 times earnings, which is way too pricey. Historically, this group's going to trade at maybe 10 to 12 times earnings, so I think I'm not sure where it is right now. I should have looked that up. It's probably down around 17, maybe 16 or 17 now. You might want to wait till this thing gets down to around 12 times earnings before you jump in to start maybe buying some of those stocks. But hey, everybody, they want their beer, their cigarettes, toilet paper, cleaning goods, that kind of stuff. So there's always going to be a market for the goods in this sector, and at some point, it'll be a good buy. Okay, someone asked about utilities, XLU. Again, something you probably don't want to own of this thing. You might be able to play bounces off this downward channel that we seem to be in. If you want to go short again up here close to 49, you could probably short the thing, run into resistance up here. 200-day moving average. But again, people buy this for the yields, and we haven't liked this since over here. We did get that pop back here in late summer. I think that was because they were thinking that we wouldn't get a rate hike in December. But stocks like Duke Power and some of the stocks that are in this thing, they're trading still at 18 times earnings, and historically those stocks trade at 8 to 10 times earnings. So XLU still looks too pricey to me. You can go on Yahoo or somewhere and find the PE for some of these stocks. When they get down around 10, 8 to 10, you're going to be good. Again, we all use electricity, gas, water, so the utilities aren't going out of business, but they got overly expensive, mainly due to the rates being down here around zero. So I wouldn't be looking to buy those anything more for the trade. We had another, somebody wanted to look at UPS, United Parcel Service. And, it looks good. We've got a nice flag pattern in here. Again, if we look at that same pattern target that we looked at with the Dow, you go up here, you go from here to here, see where take the flag in, and take this distance. You just add the points from here to here, add them from here, and go up. It's going to give you a price target over the short term on UPS of about 122. So I think you have some more upside in this thing. Plus, we seem to be having stronger Christmas sales. That's probably good for this stock. It's got to be good for their business. Now, one thing I wanted to show you, which you can, with this stock, you can't tell much from this, but this is going back with UPS about 7 or 8 years. And what I wanted to do, you can do this with almost any stock you own. And what I wanted to do is, okay, we're here in December. How has this stock done in the past in December? Okay, back here in 2009, you got a quick pop. What the economy wasn't all that great that time, so after the pop into January or so, you started to roll over. Back here in 2000, again, kind of went sideways, got a little bit of a pop into January, and then we rolled over. Here's 2011, had a nice pop, and it continued for quite a while. 2012, a real nice pop, and then it kept on going. Back here, 2014, another little pop before it rolled over. Last year, not so good. We didn't have a very good Christmas season on sales last year, and stock bottomed out over here. But when you look at certain stocks, you go back on a long-term chart, look at certain times of the year, and see how they perform. See if there's any seasonality to a stock that you want to buy. Maybe whether it's retail stock or look at some kind of sector. They do tend to trade higher or lower during certain times of the year. And in this case, UPS has a pretty good track record. Here we are over here getting ready to go into December. It's already taken off. That may be in anticipation of good sales. But you can go back, look at 7, 8, 9, 10 years, and if you see a tendency for these things to roll, going at a certain time period, it might be a good time good one for a trade. Okay, next we have Schlumberger. Okay, SLB is the symbol on this. Has a nice ascending trend line coming up that's coming down and finding support. Now, the integrated oil companies and refiners are where you want to own oil stocks. I don't really want to go out and buy Exxon. They're still paying out more money in their dividend than they're making. So that's not probably the way you want to go with these things. But the refiners and the integrated, the ones that sell the services and all, they're probably going to still make money. With this, OPEC can't really get its act together. So I don't see oil anytime soon jumping up to $60, $65. If it does, you want to be buying these things as it's going up. But you can't tell me that the Iranians are going to all of a sudden cap their production when they're still, I think, still about 1.5 million barrels a day below where they used to be. They're not, to them, they would rather probably increase production by 2 million barrels at $30 a barrel rather than cut production and only make $50 on, say, 400,000 barrels a day. So I think OPEC has some work to do, which probably leads me to probably believe that crude oil probably trades between 43 and maybe 48 to 50 on the top side. The economy continues to expand. We came out today, third quarter GDP was 3.2%, which beat estimates of 2.9. So an expanding economy can also support oil prices at that stage. So that's pretty much all I have for you today. I do see a couple questions coming in here. Let me see if I can write these things down real quick. Does Dong's Dow theory work in period of rising rates? That's a good question, Linda. That's one of the reasons why it outperformed last year, because people were chasing these dogs of the Dow. So it may not outperform. That's you can't tell. And some of these stocks again that are beat up, they're going to be in these things like say a Walmart or a Cisco or some of those things. If they're at the bottom of their business cycle, Cisco could be up 40% over the year. Walmart could have a 25% just because the economy's going. So some of those stocks that are very interest rate sensitive, they may not do so well, but you may have 6 or 7 of them that could do quite well. Just like I didn't see any of the banking stocks like J.P. Morgan or Goldman Sachs in there. You won't get a chance to buy those in January as part of the dogs of the Dow. But there will be some other stocks in there again that could do quite well. Maybe Caterpillar continues to do well if it with some of these emerging markets begin to roll up. I'm trying to write down these symbols here real quick before I close this up, and we'll go to them. Why not follow the trend by investing in the top 10, but also have a long opinion? That's a different concept altogether. If you're looking for momentum stocks, I'm not so sure I'd want to play momentum stocks just on the Dow. You could, but the reason you're buying these dogs of the Dow is because you're looking. A lot of people like momentum players. They buy high and sell higher, whereas other investors like to buy low and sell high, which is maybe a little bit harder to do. But, again, you're buying stocks that have been beaten up, they're paying a good dividend, and the downside is probably limited for most of those companies. So if you're a very conservative investor, that's probably something that, it makes sense, and then it has over a time period outperformed the Dow even, during dot-com and booms and busts. So if you're a conservative investor, I think that's a good way to go. Okay, I got 3 more stocks we're going to look at real quickly. Oops. Let me see if I can share my screen here. Can you see it over there? Okay. All right, let me get this thing smaller. Okay, first one we're going to look at is TRN. Let me get rid of some of these lines here. And I can't get rid of a lot. There we go. Clear all. There we go. Okay, TRN, Trinity Industries. Had a nice little breakout over here. Actually bounced off the 200-day, which is strong. Still trading above the 10-day, which is if you're just trading this thing, it's great. We want to buy these things above the 10-day, and if you're just on a short-term trade, you kind of get rid of them when they close below that. If you're going for a little bit more of a swing trade, you can hold on to them until they get down to the 21-day, which would be this average right here. So if you're looking for a swing trade in this thing, you'd probably sell it at 25. But it has some upside, a real nice little pennant or flag position on here. If that's the case, you could actually get a trade up to maybe 32 on this thing, which would be, we ran into some resistance back over here. A look at the point and figure chart on that, and you just had a double breakout. Again, that's also supporting the idea that you could probably get a trade at least up to 31 on that. This double top breakout looks good for that stock. So, yeah, I like it. I think you can, I'd hold on to that one. The next one over here is IGM. The technology I shared, Goldman Sachs thing. Yeah, I like technology. It's underperformed over this period right here. I think that you're probably going to see the technology sector catch up a little bit. I think it's, we looked at some of these sectors earlier, and technology isn't even in the top five sectors. It might be number 6. So I think you can get some outperformance going forward on that. Certainly it's overbought a little bit on the 30-day stochastic, but not on the 14-day RSI. And you're also down here on the MACD, LT, the longer term one. Look like you're going to get a bullish crossover here, which probably means you can start to trend a little bit higher. So I like the technology sector in here, and I think you'll probably play a little bit of catch-up ball on that, and it might be time to buy. Actually, also some of the FANG stocks are starting to outperform a little bit. People are not quite as scared about the tax thing. Now, I heard somebody the other day talk about TANG stocks, T-A-N-G, which was kind of funny. That was Twilio, T-W-L-O, Acacia, A-C-A-I, Acacia Communications. N was NVIDIA, N-V-D-A. And G was GIMO, G-I-M-O. So if you don't like the FANG stocks, you might try the TANG stocks. And they seem to be some good high momentum plays. Okay, last one for the day is SLW. Silver Wheaton has gotten crushed in here from 32 down probably about 40%. Looks like it's trying to bottom. I like the bottom over here where we've kind of found resistance and support back here before. This is called, when you have old resistance, now it becomes a new support, which is something you want to watch. It's very oversold. I'm not wild about gold and silver in here yet. So if you want to try to play a bounce in silver and gold, if I got something here on 18, if I got a trade from 18 to 20, I'd dump it as fast as I could probably. I just think that you're more in a growth position in here that you don't want to really be getting too conservative on what you're doing, even if the market has a little bit of a pullback here at the end of the year into January. At that stage, our CTI is going to go to a bullish posture. I think we stay bullish on the market into July of next year, so it should be a good spring on this. Okay, I'm going to wrap it up on here. I just want to conclude with I'll be in New York City next week, so we won't have a tech talk, but I will be back the week after, which I think would be 2 weeks from today. But anyway, I want to go over at that time. I want to update the CTI counts for the cyclical trend index and see how we're going to be, where the bullish and bearish periods for the market could be in 2017. Okay, I appreciate you joining me today. I hope you got something out of it. If you have any questions during the week, you can send them to the doc at marketedge.com, and enjoy your Christmas shopping.